I'm Dryden Pence, and this is kind of what we call the So What. It's 9 a.m. on February 28th, 2023, and I'm going to take us through a variety of things that are going on. Certainly a lot of information out there in the world, kind of bring you up to date as to where we are. First of all, past performance is no guarantee of future returns. These are the disclaimers for that. Moving on, we've been talking now for well over a year about 4 or 5 big P's that are really kind of taking a look at driving the markets and the economy. The first one was the invasion. The solution to that was peace. Inflation, the solution to that was when do we hit the peak. Interest rates, the solution to that was when we hit the pause. And then corporate profits and stuff about what's profit, what's that going to be in the future. And then also we talked about the elections, patience. So when you think through where we are in our progress, headline inflation probably peaked back in June. Core probably in September. The pause, we don't know whether it's March or May or June, but sometime in the first half of 2023. Profit growth, that's it's a question right now. Companies are in a situation where they're really toning back their estimates of profits because they don't know what their cost of capital is going to be. That's related to this pause thing. Till the Fed stops raising interest rates, nobody knows what the maximum cost of capital is. And with the elections, well, those are over with, but generally when there's split government, the year following that, you see a market that can be up around 15%. That's a positive development. Now let's talk about the invasion of Ukraine, prospects for peace. This is going on a lot longer than anybody expected when it happened a year ago. We've hit the 1-year anniversary. The Ukrainians have done a fabulous job of resisting the onslaught of the Soviets, the Russians rather. But the war is tragic. However, there are some understandings that we have to have of what's going on. And when you think about it, as you see here, this is a Ukrainian soldier holding up a javelin missile. Those things cost $175,000 a piece. What's left off to the other side of that is what's left of a T-72 tank, Russian-made T-72 tank, and that thing costs $3.2 million. I kind of like the math. We've been able to equip the Ukrainians with a lot of great equipment that has allowed them to withstand a tremendous amount of this Russian onslaught, fight to a stalemate. Now, here's what's next. Now the United States plus Europe and a number of other countries have decided to start giving the Ukrainians main battle tanks. That's really important. They're not going to get them in time for an offensive this winter. They're in fighting season right now, but they're not going to get them in time for offensive season this winter. But come spring or summer, you'll begin to see these things out in the field. And it looks like the Ukrainians are going to get almost a full division's worth of tanks. That will be a major, major game changer in this war. We think that sometime in the middle part of this year, things will be significantly different than they are today. Now, this is a quick update on the map. You can see the front is along where it is, around where things have stalemated. But the yellow area on this map was when Ukraine launched that big counteroffensive back last summer. Remember, the war in Ukraine is seasonal. You have a period of time in the winter where the ground is frozen enough that you can run a combined arms heavy equipment across it, and then everything gets boggy again until summer when it dries out well enough for another counteroffensive. So that's what we have to do. We're looking at the weather these days. You can see over the next couple of weeks, there's going to be a lot of message traffic and a lot of news about the Russians trying to break out of their defensive perimeter and counteract the Ukrainians. Ukrainians fighting back. Now, what does all that mean? The Ukrainian war has moved inflation around dramatically. And you begin to see how we saw this peak in inflation because it kind of what started it, right? It started this commodity shock, started the oil shock, all that moved, and then inflation kind of took off. We think that it peaked back in mid-June and July, and is now coming back down, and came down fairly quick, but now that seems to have stalled out a little bit. And now this is more the core of PCE. This is what the Fed really looks at. PCE is personal consumption expenditures, and this is the headline number. So you can see this is what's caused, if you look at the far right-hand side of that, this is what's caused a little panic here and overreaction market coming down a little bit from where it had this year is because people are seeing that this last read on inflation came in hotter than people expected. So we're in this moment where markets are going to be volatile and everybody's going to be hanging on to see what the Fed does next. This is the important piece that I want you to understand. There's a lag effect. We don't know exactly how long it is. It could be 4 months, it could be 6 months, it could be 9 months. Between how long it takes for the Fed to make a move, these blue lines are where the Fed has raised interest rates. How long does it take between that really shows up with the real economy? Consumer. Federal Reserve can make a decision in the afternoon. The markets adjust in 5 minutes. But consumers and businesses, well, they take a little bit longer. So what you're seeing here is if you've seen the peak inflation, that black line, and the one beneath it, which is the headline PCE, those have kind of leveled out, actually maybe turned the other way a little bit. That's in reaction to the fact that there was these gaps when the Fed wasn't having meetings, they didn't raise interest rates. So now we've yet to see the real effect of the last, maybe 100 basis points, 150 basis points of Fed tightening really show up in the economy. You can see how it's come in. So now the big question is, what happens next? What happens? We've got another meeting coming up in March, and we've got one in May and June. No one quite knows where the terminal rate, that's the highest rate the Fed puts in, is going to be. Is it going to be 5.25? Is it 5.50? Is it going to be 6%? Because the Fed is really trying to slow down the economy to tamp down this inflation. So what we probably are going to see now, folks, is several periods where the Fed raises 25 basis points on every one of them until they know they've got this under control. So watch peak inflation numbers, watch headline PCE. That's going to give you an indication of what the Fed's going to be doing next. Now, even when the Fed raises interest rates to the point that it really starts turning back down again, the big question is how sticky is it? Now, I'm showing you this slide because there's different components of inflation. You can look here, right, when we stop the unemployment benefits and then we end up with the Ukrainian war, that's pushing, that begin to see energy getting pushed up, and you get food pushed up, and you get commodities pushed up. And then all of a sudden they're coming down, and those prices are coming down in response to the Fed raising interest rates. But that purple area, services excluding energy, that's not coming down, folks. As a matter of fact, that's kind of getting very what we call sticky at around 4%. And this is why we think that inflation is not going to get down to 2% anytime soon. That we're probably going to be over 4%, at least through all of 2023. So as you're thinking about and planning and things like that, the reasonable expectations, it's a lot easier to get from 9 down to 5 on inflation. It's a lot harder to move from 5 down to 2. So we think we're going to be stuck in this area north of 4% through all of 2023. And expectations for most people, as you can see this, are about the same. They basically think we're going to have long-term inflation expectations are going to be in this 3% level, but we've got to kind of get back to it. Right now, during the next year, it's coming down around 4. Long-term, probably back down to 3. Now, what does this mean for investors? Well, first of all, I've been talking about this for well over a year. We've been talking about cash as an asset class. For all of 2023, cash was probably the best place to be. For a certain portion of your fixed income portion of your portfolio. Interest rates were going up, bonds were going down in value. You take your fixed income portion of the portfolio, kind of set it to the side, hold it as cash, and then begin to redeploy it at the time when you can get better interest rates on. Because you remember, a year ago, okay, Fed funds rate was very, very low. Interest rates were very, very low. So all of this has happened in just 1 year. So the good news now is the 2-year Treasury, those are going to yield upward 4.5%. Cash has a place to go now. Bottom line is, you think about it, we used to be in what we call the TINA market, where there is no alternative. So all the money ran into equities. Well, now we're in what we call the baby market. Bonds are back, y'all, and bonds make some good sense right in here. So you can get upwards yields of 4.5%. And this is the yield curve. And you can see that it's jumped up over the last month. So when you have the ability to lock in some money at these rates over a short period of time, probably makes a little bit of sense. The other things to remember is when interest rates go down, bond prices go up. When interest rates go up, bond prices go down. That's the way the math works on these. So we've had this whole period of time where interest rates have gone up. Bond portfolios have been going down. Now we're getting close to probably a peak. We're somewhere within 100, 150 basis points, or 1.5% of the top of the Fed tightening. Well, if that happens, then that's where it's going to peak, and then it'll go the other way. So it's important to recognize now is probably a good time for us to think about redeploying capital that you have in the fixed income area to the short intermediate part of bond. Let's talk about equities. Well, as you can see, equities have been tremendously volatile, and the amplitude of that volatility has increased. Now we're into the far right of this diagram. What are we doing in 2023? Remember, equities were really knocked down dramatically in 2022. It was in response to the Fed raising interest rates. We had pretty much one of the worst years that we've had in 70 years. Now we're kind of past those big adjustments, and we're looking into the new world of 2023. And the markets responded very well at the beginning of the year because everybody was just so happy to see 2022 in the rearview mirror. But if you look at the market, we got ahead of ourselves pretty quick. This is the range fan, and I've shown you that many times. We calculate probabilities on earnings and stuff on the S&P. But the key thing to pay attention to here is that market jumped up, got a little bit ahead of itself. You can see it coming back now. We think it's going to bounce around in this range throughout the rest of the year, and it's probably a positive single-digit mark, high single digits, low double digits to the positive. Think through it. Keep watching this video, and we'll talk about tracking this progress every year when we do these monthly. The big thing to remember is markets going to be volatile. This is a big period of adjustment, and markets are going to be volatile. Well, the thing to do is take advantage of volatility. Don't be its victim. Think through these things, and let's figure out exactly the right place to be in our bond portfolio, our fixed income, and in our equity portfolio. It's important to remember, take advantage of volatility. Don't be its victim. There are bargains out there. If you're a long-term investor, there's good opportunities. The big question in everybody's mind right now is what's going to happen with the Fed? Are they going to pause? Are they going to pivot? Or is there going to be no recession, a little recession, or a big recession? Well, here's what we think is going to happen. Sometime in the first half of this year, Fed's going to pause. That's going to be very significant. And then they'll probably pause for a very long time, stop raising rates, and they'll let households and businesses kind of catch up to the new rate regime, how much it costs. Cost of capital for payments in terms of trade, cost of capital home mortgage interest, cost of capital that families have having to pay. And then they'll eventually pivot, which means lowering interest rates, but we don't see that happening until well into 2024. So that means we're also in the camp of there's either no recession or a little recession, probably leaning more to a little recession back half of 2023. It's one of those things that may be over before you know it's there. We do not believe at this point we have a big, what one would consider a big R, ugly recession in 2023. And let me show you why. If you look at this, we have more people working today than we ever have. More people are working today than ever before in the United States. And they're making more money in real terms than they've ever had before. So when you think about this, it's very hard to have a recession when you've got more people working, making more money than they ever have. And as a matter of fact, the economy is pretty darn strong. We have almost 2 jobs for every person looking. This is important, right? Because one, that gets to better consumer confidence. If someone's going to lose their job, they know they're going to go out and get another one pretty quick. They also know if they're not working, all they pretty much need to do is raise their hand and they're probably going to get a chance to get a job. So the job market in the United States is exceedingly strong. And I want to take a second to dive into this a little bit and talk to you about one of the things we look at. That's called labor force participation. How many people are eligible to be in the labor force but are not yet there, right? And you can see COVID, all of this is a reaction to COVID. We stopped the economy in response to COVID with massive unemployment because we stopped everything, and then bounced back up. You can see that in that purple line. And then for a long period of time, you didn't have a lot of increase in labor force participation because basically people were being paid not to work. So if you're being paid more money not to work, why go back to work? That's what we did, and that's what happened. So you can see in this chart, when you hit about late August, right, then they stopped that program. And as when you stop paying people not to work, labor force participation increased up till you get to that March period of time. And now we're kind of bouncing around this new higher level. When does that change? Now, this is important. The tightness in the job market will go down when labor force participation goes up. And that's part of the inflation that we're worried about. Tightness in the job market will go down. Labor force participation goes up. Labor force participation is going to go up when people spend down the money that they've saved. The folks at the lower end of the economic spectrum saved a lot of money. You see this, that's a purple down the bottom. You see, they saved a lot of money because of what they were getting during COVID. Well, now they're bleeding that off. And when that number goes back down to where it was pretty small back there in 2020, right? Then what you'll see is people go, okay, I burned through all my savings and now I'll go back to work. That's where you'll see it. So you can begin to read these trends like a map. So savings are pretty good. We've got excess savings, about $1.7 trillion. That's coming down. It's directionally correct, but we're not there yet to the point that you're going to see a lot of labor force participation increase. Let's tune into that probably in 3 or 4 months. I think it'll be different. Big question. How much will the Fed raise interest rates in March? Probably 25 basis points. And how many raises after that? Probably 2. Well, that's going to be important because then, as I said, we'll be hitting terminal rate by the middle part of the year. That's going to be positive for markets. That's going to be positive for the economy because people can plan better. So it's hard to have a bad recession, low unemployment, and reasonable balance sheets. Walking you through the things. Peace, we don't know about that yet. Probably latter part of the year, there'll be some major changes on the ground. Inflation, we've hit the peak. Now we're headed down the other way, but it's getting very, very sticky, and it's kind of difficult to get past this 5 number. We'll have to wait and give it some time for these interest rate increases that we've had to work their way through the economy. We'll have to tune in and take a look at that here in a couple of months. There's some key data points coming up. Interest rate pause, probably June. So we're going to have to wait till there. And until that happens, you're going to see a volatile market that's going to move around. Profit growth. So far, earnings are coming in above expectations, but not as high as people were thinking. And when people are doing, chief financial officers are doing their projections about things in the future, they're really saying, well, we don't know. It's a very muted attitude about those things. And it's very simple why. They don't know their cost of capital. Until the Federal Reserve stops raising interest rates, it's very hard for a company to know what their cost of capital is going to be in a scenario where they can program out their worst case scenarios. So chief financial officers are not going to be overly robust about earnings predictions because they just don't know what a big cost of their cost structure is going to be like. It's the same thing in a household, in your household budget. If you have a variable rate loan, you don't know what your house payment's going to be in 6 months. Well, that means you're going to be a lot more careful about how you're going to spend money. Now, moving on. What are the key dates? Got a couple of key pieces of information coming out. That jobs opening and turnover report, part of this labor force participation, all those things, early March coming up. We've got average hourly earnings coming up. That'll tell us a little bit more about inflation. Unemployment rate coming out March 10th, non-farm payrolls March 10th, CPI on March 15th. That's the important. CPI read March 15th is in front of the next Fed meeting. They're going to be looking very careful at that. If the trend goes back up, that's not a good thing. That's not a good thing. But if the trend begins to continue to trickle down as these previous interest rate hikes work their way through the economy, CPI bleeds off a little bit, then I think that will be positive. But at this point, it's really hard to know. Fed meeting is March 22nd, and they have personal consumption expenditure data coming in March 30th. So remember, this is the chart to pay attention to. The two lines to pay attention to are the very top one that says 6.4 and the other one that says 5.4. You really want the angle of those slopes to fall down and to the right. That's important. And we want the Fed to stop raising interest rates somewhere around 525 to 550 and then pause out for a long period of time. Those developments should be positive for the economy, should be positive for the markets going forward. We're in a wait and see world, but we're a lot better off than we were 6 months ago when you were having to look at continuing very large interest rate hikes. We're getting much closer to the period of time where the Fed says, we're done. Now you can go about planning your future. I hope this has been helpful. I hope it explains a little bit of what's going on. What's the so what of all the news? Thank you very much. Hope you enjoyed it. Tune in next time.